So we have given 7 minutes, so that's enough time actually. So, all right. So we are continuing with the discussion of the simple trading system. Once again, very quickly to set you up as to where we are. We are in discussion of the various decision problems, and we are trying to define a simple trading system where we are going to focus on, we're trying to define a very minimalistic trading system first with only these 3 additional problems solved, 4, 6.2, and 7. And in addition to 1, 2, and 3, which I have already solved for you. All right, so this is where we are, and we came here actually through the discussion of the differences. We were on DP4, and we started discussing the differences between FA and TA, and then we saw the first difference on market rationality, the second difference on cyclicality, and then we went into the cyclicality note. We understood the different characteristics of cycles, and from there we went on to define the trading system. We're trying to define a trading system so that you can quickly solve your decision problem. So where we were basically is trying to establish how we would trade. So you would have 2 broad approaches, either momentum or mean reversion. So I've rewritten the rules a little bit, I edited these rules a little bit so that it's a little bit easier to understand, more precise. So we looked at some situations as to how you would decide. You've got 2 time frames, and just for the sake of example, I've taken 1 year and 3 months, but you can take any 2 time frames. And so one we'll call long term or big picture, and one we're going to call short term. Okay, so ST is the abbreviation, long term LT. So these are the terms that we are going to use. Am I still audible? Some of you are, let's say, ask Utsav, can you hear me? What is happening? Sachin, can you hear me?
Yes, sir, I'm hearing.
Okay, because some of the other students are not responding, so I'm a little bit concerned. I don't know, when I look at them, say when I ask some of the students, I see that the sign is showing us connecting to. So anyway, so at least I just want to make sure I'm audible. Okay, so this is where we are. We are trying to decide with these 2 terms. So we are trying to define a very simple trading system, which as far as the DP4, whether to buy, sell, biased is the buy-sell decision problem, DP4, which we briefly refer to as the buy-sell decision problem. As far as this is concerned, how do we solve this? We make sure we always use 2 time frames, and that's how we try to solve it. And we're trying to explain how we do it if you have a momentum approach and if you will have a mean reversion approach. So momentum we have already clarified. You can have, I just opened the other, that Vivekananda chart as well. Try to bring it in here.
Sir, my audio was not connected. That's why I couldn't hear you.
Okay. All right, no problem. Okay. So yeah, I was just concerned that, whether I was audible or not. Okay. So, so we are going to decide now. We were discussing mean reversion the last class and the previous class. I'll just quickly run through now. In the case of momentum, how would you decide? Let's say, for instance, if you go back to FCX very quickly to run up. If we do a 1 year chart, we see that the 1 year trend is up. Okay, and so what we have defined here, if we go back to the trading system rules in the case of momentum. So we're defining these rules for solving the DP4 buy-sell problem. I'm just doing a quick recap here. 1 year and 3 months are our 2 time frames. So you must have 2 time frames. And here the rule says what? Trend on both time frames must be same. What are the conditions for a clear buy-sell solution to DP4? So DP4 is concerned with the question of, when I look at a particular chart, should I be buying here or should I be selling here? and that's your DP4. That should be whether my bias should be to sell or to buy. Okay, and then later on we come to DP5, which is the entry price, whether I should enter at market or limit, etc. But this bias question, and how are we solving it here? So what we are saying is, what are the conditions that must be satisfied for a clear buy-sell solution, okay, to DP4? The trend on both must be same. T frame is time frame. Okay, you can call it pattern, time frame. All right. So trend on both time frames must be the same, up or down, and the trends should be intact. Okay, intact means not neutralized. Here we can say, if we are looking at these high, 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 here high, this one, maybe you look at this one, this one, this one, and the lows are all here, 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 this one, this one, this one, this one. Okay, if this is how this is the size of pattern you're looking at. In that case, this trend, we will say the trend is up and it is intact, in that this low, which is now the highest low from which a new high was made, in the case of an uptrend, this is how we say it. This low has not been broken, so this trend is intact. Okay, so that's all we are saying here. In the case of momentum, both the time frame trend should be up and the trend should be intact. Okay, non-neutralized. Intact means non-neutralized. So that's what we see. In the case of FCX, we have a very clear decision, because the long-term chart trend is up. Okay, this is a 1 hour chart, 1 year chart. The trend is up, and I go to 3 months. 3 months also the trend is up. Okay, so clear decision as far as the chart is concerned. This is an example of a chart where you have a clear decision. Okay, let's take one more case where you don't have a clear decision, which we saw the other day, Ford Motor. Now, Ford Motor, when we look at the short term, this is also one of your tickers. When we look at the short term in Ford Motor, we see that this is a 3 month chart actually. You can look at 6 months and then we can come to 3 months. So 6 months also is up, and 6 months is not really relevant, but 3 months for our system, 3 months. So short term pattern is up, okay? And here you see the beauty of why we need two patterns, two systems, because we don't want you to, this is why we have said here, why two screens? So that, remember, we follow this principle which we learned, that smaller price cycles are constrained by the larger price cycles. So we don't want you trading against the long-term trend. So in the case of Ford Motor, you can see the 3 month short-term time frame, short-term pattern is small picture is up, but when you go to the big picture, you see problems. Yeah, you see that there is a downtrend. Okay, you can say that if you look at very short term here, if you look at this small pattern here, you can say it is neutralized, but there is actually a pretty strong downtrend. And if you go even further, as I said, you should always look at, although we have given you only 2 time frames to trade with, because we want to keep it very simple at the beginning. In the beginning, we want to keep things very, very simple. So we are just teaching how to trade with 2 time frames. So therefore, we have kept only 2. But in practice, as I said, you have to look at all the time frames. Ideally, you want to get a charting system which allows you to look at multiple time frames, not just 2, and gives you all the data on the history of the market that you could possibly get. Right? So I'm just going to bring in this as an example what I was talking about. This one, this is a chart of crude oil prices. And you can see here we've got all kinds of time frames, and we've got a huge amount of data on crude oil. And so this is how you should look at every market. So if you try to follow this, in the case of Ford Motor, if we look at even at least 5-year data, you can see how such a long downtrend there's such a long downtrend in the price of Ford Motor. So therefore, this is why we don't want you to get swayed by the short-term uptrend on a 3 month time frame, and we don't want you to trade against a long-term trend. So what will happen in the case of Ford Motor, unlike FCX, where we saw that we had a very clear decision that we could buy, we could have a buying bias. In the case of Ford Motor, we find that although 3 months is up, the 1 year is actually down, right? So therefore, this is not a good, so there is no match. The long-term trend is down, but the short-term trend is up. So that doesn't work for us because the rule says both the time frames must be in the same direction. So we can't follow this. We can't actually get a clear solution here for. So in the case of Ford Motor, our decision is going to be, because remember the short term is the trading time frame. So in this case, we say we can't do anything. We don't have a clear bias. We'll have to wait and see what happens. Okay, we can't do anything because from a momentum perspective, we can't do anything because the two time frames are not pointing in the same direction. Okay, then we wanted to just look at quickly at mean reversion. So any questions on momentum so far? Clear decisions? We can look at some other charts also. We can look at maybe Boston Scientific with all the, this is a biotech company. This is with all the vaccine talk and everything. This is our 3-month chart. Okay. Let's look at 1 year first. Okay, so 1 year on Boston Scientific, again, the trend is down. The trend is down. You could say there is a neutralization here. It's not, but at the same time, the big picture seems to be down. So this is down on the long-term trend, big picture. Small picture when I go to 3 months. Yes, small picture is up. Same problem as we had in the case of Ford Motor. The big picture is down, small picture is up. So we can't do anything, okay, from a momentum perspective. So we can't do anything. So we let this go and so on and so forth, all right? So this is the example of momentum, so no question. I'm just quickly going back to mean reversion now. What will you do? So what have we written now for the mean reversion? That I've written the rules in a negative way, but I can also write it in a positive way. If we say that can't trade against long-term pattern is, that means essentially we can just write it in a negative way and see it. I'll explain to you. We've already done that in the last session, right? So the first rule is can't trade against the long-term pattern, okay, and can't trade against an intact trend, okay. So intact, this term we will use very often. So if you understand what that means, intact trend means that the trend is has not been neutralized. All right. So that's what we mean. So in this case, we can say that the 3-month trend that we see on Boston VSX is intact because it's not been neutralized. Any reasonable person, I think, once you understand the high lows that we are looking at, if you're looking at this size of pattern, this is a low, this is a low, this is a high, this is a high. So immediately once I point out the first two lows and highs, you know what size of pattern I'm looking at. So then you can figure out for yourself the next lows are here, here, and the next highs are here and here, okay? So therefore you can see here, this is not neutralized, it's intact. It's an uptrend and it's intact. So that's what we mean, all right? So in the case of mean reversion, you can't trade against the long-term pattern and you can't trade against an intact trend, okay? So essentially that means, let me clarify this, intact trend means, okay, short term, because the trading always happens on the short term, okay? Can't trade against an intact trend. And actually, this applies for both short term or long term. So let me explain what this means. Let's go back to the example that I think is not in your, okay, let's try LBS and see what's happening. Okay, now you see, this is interesting in LBS. This is a 3-month chart, okay? You can first go to 6 months and then look at 3 months. And see. Okay, so this is a 3-month chart in LBS. This is one of your tickers, Las Vegas Sands. This is a gaming company. These are casino companies are called gaming companies. Okay, they're a very big gaming company. It's a global company. They've got casinos in Macau as well. And obviously they started, I mean, Las Vegas is the gambling capital of the world. So this company, LVS, 3 months, interesting. Now remember, we are looking at it from a mean reversion point of view, okay? We're looking at from mean reversion point of view. So we have the rules: can't trade against long-term pattern, can't trade against an intact trend. Now, remember mean reversion, the thinking of a mean reversion trader is always to go against the current trend, all right? And remember that the trading is always focused on the short-term pattern. Okay? All the trading decisions are made on the short-term pattern, selection of stop and all that, and development of perspective, okay? So when I'm looking at this as a trader, I see initially when I see a long-term trend, this is a short-term, the small picture, small short-term trend. Because if I'm a mean reversion trader, let's say I'm over here, okay, I'm somewhere over here, or even when I'm here, the problem is I see there's already an uptrend because this high is made later at this point. I want to go short, but I can't go short initially because this uptrend is intact. If I'm here somewhere, I see a low, I see another low, I see a high, I see a higher high. I don't see a break of this trend. So around this point, I can't go short. When I'm looking at it here, my intention is to go short because this is an uptrend and I'm a mean reversion trader. So whatever I see, I want to go against it, okay? But I can't because my rule says I can't trade against an intact trend. In this case, at this point of time, when all this has not yet happened, So when I'm somewhere here, I can't go short, although I want to. If it's an uptrend, I want to go short. If it's a downtrend, I want to go long. But here I can't go short at this point because the trend is intact. Okay, this uptrend which is developed from here. Okay, this is the lowest point on the chart. At this point, this is the highest point. So the uptrend sequence of higher highs, higher lows has not been broken. So therefore, I can't go short at this point. Okay, because I can't go against an intact trend. But now look at what has happened last night, okay? See, now you see this break that has happened. Now you see what's happened is, you can see low, 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 and then the two highs. But now you can see that the trend is no longer intact. The trend has been neutralized, okay? So this now as a mean reversion trader, as we were discussing in the previous class towards the end, this is the first opportunity. This is actually the classical way to enter on the mean reversion trade. Now you can see, okay, good, I can enter now, okay? But you have to check one more thing, which is on the short-term pattern, which is your trading time frame, you do have a signal from a mean reversion point of view because you had an uptrend, so you naturally wanted to go short. And now you've got the neutralization of that uptrend as well, okay? So you can go short. But you have to check one more thing. What is the other rule? I can't trade against the long-term pattern. So if I'm going short here, I need to make sure that the long-term pattern, which for the purposes of our example is 1 year, I have to make sure that that is not up. Because if the long-term pattern is up, then I can't go short. That's what it means, okay? So can't trade against long-term pattern means, let me explain that, just to make sure there's no confusion. I'm going to put it this or, okay? Okay, that's what I have to check. So I have to now check long-term for LBS. Okay, so long-term is down. Okay, you could say here this small uptrend, this high has been broken, so it is down but neutralized. But it's more or less, if you look, we don't look like this. When we look at this thing, we only see this high, this low, and this low. The trend is still down. Okay, so it's a weak pattern on the long-term charts. So the long-term trend is also down, and the short-term, I'm a mean reversion trader. I can now go short because the uptrend on the short-term trend, on the small picture, the uptrend has been neutralized. This is my classic mean reversion entry. So as soon as this low is broken at this point, I can go short. Okay, so here you see an example, a classic example of a mean reversion trade, which you can do by checking these two things. You wait for the, you see a trend and immediately you want to go against it, but you can't go against it because of the second rule, can't trade against an intact trend. So you have to wait for the trend to break. Okay, and then you have to also check that the long-term trend is not, you're not trading against the long-term trend. Okay, that's what it means. So if the long-term trend, in this case, you can trade the LVS, you can go short. Okay, so this is the classic mean reversion trade, which we call this is a way where you when you go. So if you give an example of what we discussed the other day, when we were talking about when Vipul had given another example of a different type of approach to mean reversion. But that, as we will see, is actually not a classical mean reversion approach. I'm just going to explain that, okay? Which is that we had that actually written down in our session notes. Okay, let's open the session notes. But we basically have that here. We can just write it here. Just copy it from the session notes. So that was the first report. The one that I just explained on mean reversion is what we call the aggressive approach to mean reversion in the previous class, and that is actually the classical approach to mean reversion, because mean reversion itself is an aggressive kind of thinking, because you want to go against the current trend. Okay, so this is just a safeguard that we have built in, because the trend can continue to run up, and we don't want you to go enter your position against the trend until at least the trend has been neutralized. Okay, so that's a safeguard that we are putting in. So we don't see you going against the trend straight away. Right? I go back here. Okay, I don't know where, maybe it's in the DP4 solution where we have written. Anyway, it doesn't matter. We can write it here. Okay. So example where you see the first type of trading which you have. Okay, yeah, so I'm just trying to copy that. Yeah, this is what we had written in the previous class. We can put it here. Okay. This is what we have just done. Aggressive. Wait for current trend to be neutralized before entering position. This is the example I gave you. This is what is happening in LVS. Wait for this to break, and then you enter the position. Okay. And the other one that I had written is the conservative approach, which is wait for two things, which is current trend to be neutralized, okay, which is you're basically following this rule. You can't trade against an intact trend. You have to wait for the trend to be neutralized, and then you wait for a new trend in the opposite direction to develop, okay, before entering the position. But this one actually is, it's almost, because what you will see is that this is all here. This approach, the so-called conservative approach is basically indistinguishable from momentum at this stage. Okay, so we will not see this as a this is the classical mean reversion approach, which is the aggressive approach. So let me just write that. Okay, because this conservative approach will effectively just show you that it's actually the same as the momentum approach in this case. So we'll let that go, because then we want to make sure that this is understood as the classical approach to mean reversion. Okay. I'll explain what I mean. When I explain visually, it will be clearer. Classical means the correct way or the more proper way. Okay. So this aggressive approach is the classical approach. Well, let's put it this way. Classical mean reversion style and it is distinct from a momentum approach. I'll explain what I mean, what I've written over here, then you'll understand what I mean. Okay. Distinct from a momentum approach. So what we are saying is, that the so-called conservative approach, which we discussed with based on Vipul's input at the end of the last session, this we can put. Okay, so you understand this as the correct mean reversion approach. If you want to be a mean reversion trader, this is what you should be doing. All right. The conservative approach is this one. If you see, is not distinguishable I'll explain what I mean. Okay. So when we say momentum mean reversion, we are describing them as two distinct philosophies. So mean reversion cannot be momentum and momentum cannot be mean reversion, because this is a taxonomy of approaches to trends, or perspectives on trends when you're talking about which way you should be trading, whether your bias should be buy or sell. So therefore one cannot be the other. Okay. So therefore the so-called conservative approach is not distinguishable. And so let me make it very clear before I go to the picture and explain it to you. Hence, not recommended for implementing the that's what we are saying. Okay, so you forget about this for implementing the mean reversion philosophy. Okay. Okay, let me explain what I mean. Okay, this is the aggressive approach that everybody has understood. Let me also explain once again the rules of momentum trading, so that there is no confusion as to understanding the rules of the classical, the rules of mean reversion trading. If we go back to the example we took in the last class, which is Procter & Gamble. So although it's not in your ticker list of tickers for the project, this is 6 months Procter & Gamble. Okay, let's look at 3 months. So initially we look at the 3 months. Because that's our trading time frame. And remember, I'm a mean reversion trader. In this case, now we're talking mean reversion. We discussed this, that this guy is following this trend, but he's not able to go short anywhere because the trend is still intact. The uptrend is still intact. All these higher lows, if you follow this, then maybe this, all the lows are higher. This one is higher, still higher, higher. This one. Now finally, this highest low from which a new high is made, this low, the highest low is now finally broken around September 4th, okay, which we saw. So this is the aggressive or the classical mean reversion traders entry point, okay. But this is only the small picture. Don't forget that. This is only the small picture. But at least, okay, this guy gets excited. He sees, okay, now I have an entry point. because all through he doesn't believe in this trend. He thinks this is going to turn around and go down. And so he gets the first signal, okay, that at least the trading time frame, the uptrend has been neutralized. So it's no longer an intact uptrend. So now he can go short because the rule says, the rule says can't trade against an intact trend. Okay, fine. But now he says that, okay, now the trend is no longer intact, so I can trade against it. But we have to also remember rule number 1, can't trade against the long-term pattern. So this guy now has to check what is a long-term pattern. For the purposes of our discussion, we have defined long-term as 1 year. So he checks 1 year PG. Okay, now you got a problem because the 1 year trend is up and we don't look at such small patterns here. In the long-term pattern, we only look at these 3. Okay? Low, low, high, high. No neutralization has happened over here. Okay, it's a long-term uptrend and it is intact. So therefore, the first rule is not satisfied. So although we gave you the example of PG because I wanted to show you an example where on the trading time frame there was a case of neutralization. So that's why we looked at it. But when we come to rule number 1, it's not satisfied. So let me show. So we have discussed 2 things. In the case of LVS, we have shown you how a aggressive and classical approach to mean reversion can be applied. Okay, because the long term is neutralized, long-term trend is neutralized. You can go against it, and the short-term trend is neutralized. So you can go against it, and the long-term was also pointing down, so it lets you go short. And then we saw one example in the case of PG, which we had discussed several times. But PG, you can't actually go short because the first rule is creating a problem because the long-term pattern is still up, and so you can't go against it. So therefore, PG, you can't do this. Okay. So now let me explain why this. The other point that we'll forget about the first rule for the moment to discuss why this aggressive approach, the conservative approach, is the same as actually momentum. So that's why it's not a distinctive approach in mean reversion. Okay, so it should not be understood as part of mean reversion. But let's understand what. But what Vipul was saying is actually a correct way to implement the trading system that we have taught you, which is higher highs, higher lows, etc. So what Vipul was saying, looking at PG, what he was saying, if you zoom into this, we don't have to zoom in, also fine. He's saying that this is not sufficient for me to go short. Just the breaking of this is not sufficient. I need to wait for this low to be broken on the downside. Okay, this low has to be broken further. What will that create? That will create 2 highs and 2 lows, right? So that will create a situation where you have actually now the development of a new uptrend. Okay, so that's what he was saying. Now this will create the development of a new uptrend. Okay, but think about this. If you see a momentum trader wants to trade in the direction of a trend. Okay, so here, as soon as this thing is broken and a new low is created, so the momentum trader can already see that a new downtrend has developed on this small pattern. Not all the way from here, but on the, just if you look at this part, a new downtrend has developed. Okay, so therefore, this is a new downtrend, and he wants to trade in the direction of that downtrend. Okay, and he will see. Obviously, the big picture we are just ignoring for the moment. We are just using PG as an example. Okay, so at this point of time, even the momentum trader might be going short. Okay, so that's why we are saying this is not a classical approach of mean reversion, because when we say mean reversion, it should be distinct from momentum. Okay, and if you start looking at the time frames, eventually you'll see everything requires momentum for success. So in that sense, everything is momentum, because even in mean reversion, when you go short, you require the market to keep dropping further for you to make money. And if the market keeps dropping further, if you look down on this part of it alone, okay, then it's still momentum because it's going down. The trend is keeping on extending in the same direction. So in that sense, it can get a little bit confusing. So I think the classical way to understand mean reversion is, so therefore, don't think of this as a mean reversion strategy. So in the classical approach, you can see, it's what we can call a conservative, but it can get confused with the momentum strategy. So better to learn, not to learn this as a mean reversion strategy. So in this case, what you see is that this is the better approach in terms of mean reversion, that as soon as the downtrend is, uptrend is neutralized, you can go short. As soon as the downtrend is neutralized, you can go long. So for instance, I think if you see, we're just looking at GE, okay, here, this is not on your, I think GE is not on your list of tickers. Oh, it is actually, GE is on your list of tickers. So now you see, this is 6 months. I keep doing 6 months because I just want to make sure that you want to first go to 6 months and then come to 3 months. Okay, see on GE, if I'm a mean reversion trader, and this is my short-term trading time frame, what do I see? Okay, we've got a downtrend coming up from somewhere here, some high, low, another high, low, another high, lower low. All the highs are lower, all the lows are lower, but what do we have here? We have a little break to the upside. Now suddenly you see this downtrend, 1, 2, 3, 4, 5, this kind of downtrend. This high has been broken. So if I'm a mean reversion trader and this is my short-term trading per time frame, I do have it, because when I was looking at this declining like this, I was of the view that I want to go long here because it's going to go up. But I could not go long at these kind of times because I did not have a neutralization of the downtrend. It was an intact downtrend. Somewhere here, high, 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 lower highs, lower lows. No neutralization of the downtrend at this point. But now I have it. Okay, I have a big move up. So, and this is broken. So now I have it. I can go long, but I still need to check the first rule. Can't trade against the long-term pattern. This is my short-term, small picture. Let's check the big picture. Okay. Now, big picture here, you can actually trade because see, when we say this, okay, here we can say that this is actually, now there are two, this is a problem actually, you can say in a way there is a problem. So we'll stick with the simple approach, okay. You can apply two shades of this actually, that you have, in this case, let's look at the simple system first. Here you again have a problem because when you look at, is this a 1 hour, 1 year? This is a 1 year time frame. 1 year time frame is down actually, so you can't do this trade. Although this looks good on the short term pattern. 1 year time frame is down, so you can't do this trade. Okay, this is the first way to look at it. So I think we'll keep it simple and we'll apply this kind of a filter so that you can implement it easily. All right. There is another way of doing it actually. That is to say that if the long-term pattern, the long-term trend, okay, has been neutralized, then you can trade against it. Okay. So if you apply that, but we will not complicate that. We'll keep the system very simple. Okay. But if you apply that rule, then you can trade on GE. You can go long as a mean reversion trader because although you have a long-term downtrend, it's not an intact downtrend because if you have this one decline, fairly big high over here and then down, but this high has now been broken actually, right? So therefore, the long-term downtrend is actually not intact. It has been neutralized. So in that sense, this is the further refinement if you want to do that. But we are not going to I'm just giving you the idea so that we discuss it. But I don't want to put it down on paper because I want to keep the system very simple. Okay, so in this case, applying our very simple classical system in mean reversion, even in the case of GE, we have a problem because we can't trade against the long-term pattern. Okay, the long-term pattern or the trend. Right. So in the case of GE, we look at the long-term trend and we see that it's down, so we can't go long. We wanted to go long, we can't go long. Okay. Let's see what else can we look at. Let's look at ADM. Okay, now here the trend is a little confusing, but I'm pretty sure this new high is actually the highest point. Okay, so but it is almost a neutral kind of trend. Okay, but it's now the highest point, so we can say this is an uptrend in the case of ADM. So you can actually, in this case, it's pretty clear that yeah, there is no trade for the mean reversion guy here because the mean reversion guy wants to go long, would want to go short in this picture. And low, low, maybe you can take this low, low, here low, here low. No neutralization of uptrend. The uptrend is intact. So the mean reversion guy can't do anything. But can the momentum guy do something? Yes, because short-term trend is up. The momentum guy then wants to buy. In the case of a short-term trend, if the trend is up, he wants to buy. If the trend is down, he wants to sell. But the momentum guy has to go back and check his rules. Trend on both has to be same. Trends should be intact. Okay. So let's look at the long term for ADM. This is a food processing company. Okay. So as you do this project, well, it could be a lot of work, but this is how you learn. You don't learn without without putting in huge amounts of effort. So one of the other goals of this project is, as you do the project, you should also learn about. You're already going to get a understanding of sectors because we are dealing with different sectors, and so you understand how any stock market can be split up into sectors as a classification system. And then you're looking at. You should also get familiar. Many of these companies are quite big. So you should get familiar with what industries they're in. That will give you a good understanding of global business, how it's organized and how different companies, what are their dynamics and all that. So ADM is a food processing company. So momentum, you can go long. 1 year is up, okay, and not neutralized because 1 year support is over here. In this trade, high, and high, you can say, or you can even ignore this actually. You can just take 1, 2, 3 low, and that's it. Okay, and you can say uptrend, not neutralized, intact uptrend. And you come to 3 months, it's up, okay, intact. This is the correct support, okay, which is not being broken, so the trend is intact. So you can go long here. All right. So here's an example where you can apply the momentum system. Okay, so far, any questions, guys? The very important part, this is a decision where most people get confused. DP4, when you look at a chart, whether to buy or to sell. And so we have given you some simple rules with which you can implement the buy-sell. You can solve your buy-sell decision problem. What should be your bias? Okay, buying or selling bias. And in many cases, you may not be able to do anything. So you may actually go through something. Let's look at one more in the vaccine. Since we're in the vaccine mode, let's look at Immunomedics, which is again a biotech company, as you can see. All right, now we see there's some vaccine news or something. I don't know. They must have got something. So you can see a very big jump. Okay, let's look at 1 year. And again, you can see this is clearly an uptrend, and it's not been broken. So quite dramatic jump. And as you can see, this kind of movement that you have, this is one of the problems of equity trading, that you can get very big gaps in the market. So this means the market, the previous day it closed here, the next day it opened over here. So very, very big gap, okay? So this is one of the problems. But anyway, let's look at this from a decision point of view. Clearly, long-term pattern up, short-term pattern up, okay? And you can go short, and you can, I mean, if you're a momentum trader, you can go long. If you're a mean reversion trader, you can't really do anything, okay? So this is your situation, and we have this set of rules. So it's just, so any questions at this point? So because now we have actually given you a clear framework for solving your DP4. We will now go on to the other decision problems so that you can operate in your project smoothly, right? Any questions at this stage on how to do DP4? How?
Sir, about immunomedics. Sir, it was acquired by a company Gilead. But sir, you said that while doing TA, we should not look at news
Audio,
and we should focus on technicals.
clear. Siddharth, right?
Yes, sir.
Your audio is not very clear. Anyway, go again. Yeah, what is your question?
Okay, sir. Sir, I was talking about immunomedics.
Yeah.
The company was acquired by a Gilead, but you said while doing TA, we should not look at news and only focus on charts and technicals. But sir, if we could have focused on news also, then we could have predicted the price movement that it has doubled, right? So it would increase. So sir, should we do that? Should we consider the news also while doing TA?
Yeah, well, see, if you are, let's put it this way, if you are a classical TA trader, you should not do it actually. A classical TA trader does not look at news, okay, the pure form of TA. So since the way I like to teach it is that when you are learning a particular way of particular trading approach, you should apply it in the pure form, okay? Later on in life, you may mix up the two approaches, okay? That is your decision, but when we understand, because we want to, the reason I say we should apply it in the pure form is that we want to make sure we understand the system very well, okay? So we don't want to confuse it with fundamental input, but we want to, in that sense. And even in real life, my recommendation is for implementation is to have, by preference is, I prefer to have a pure approach. But in the case of equities, you can have some application of fundamentals because as you see, as you said, in the case of this, there's a merger, there's a corporate event, there's a merger event. So this changes the dynamic a little bit. It changes the risk picture also, okay? Because this jump now, the merger has been announced. Now there's some uncertainty as to whether it may close, okay? So those uncertainties as they remain, there is some element, the risk is a little bit different. So in real life, I would say the answer to your question, because your question is really not from the point of view of learning TA, but applying it. And then if you're applying it in the real world, then you may want to take into account some of the, especially in the case of equities. If it was foreign exchange, I would say you don't need to look at fundamentals at all because you really can't, the fundamentals don't make a lot of sense here. But in the case of equities, it affects the liquidity sometimes. You do have to look at earnings dates. Okay, so the short answer to your question is that, yeah, you can look at some of that. You can mix it, but make sure that, because at this point, my concern is to teach you the technical, the TA techniques, okay? I want to make sure that you understand the TA techniques properly. So that's why I'm teaching it in a pure TA kind of a paradigm. Is this clear? Yeah.
And sir, what if we don't factor in the news? Then sir, how while doing TA, how do we factor in this jump into our calculations?
No, you can't factor it in. So as I said, okay, now we can talk about the risk a little bit. One of the problems that happens, see, is that, let's say in this case, in the case of equity, you can have very big jumps. Okay, so here there is merger news. So one of the problems is you can't actually predict it. But what will happen is, let's try to look at it from a, let's go back to the 1 year. Okay, now you see what happens is the 1 year it's already on an uptrend. Okay, let's say before we come to this part, before we get the jump, we just look at it here. When you look at 1 year, it was already on an uptrend. Now 1 year, 3 months is just the two time frames I've given you. Okay, so 1 year was already on an uptrend. Now let's see what could have happened. Let's understand. This question is a good question because it leads us to the discussion of risk, slightly away from our discussion here, but let's understand the idea of risk. Okay, so let's put this into the session notes for today, and we will now later on I'll figure out where to put it. Okay, so this is we are still discussing that. We don't have to keep repeating this, so we'll write it here. All right, so here let's take example in view M&A event. Okay, big price jump. This is an important question, so I want to spend a little time discussing it. Big price jump. Okay, then and discontinuity. Okay, because this is what let's call it. Let's use the technical term. Big price gap. Okay, so this is called a gap. The technical term is this is a gap. Okay, don't think of clothing, but this is a gap. We call this a price gap. Okay, this price gap happens because some news comes in, which affects the market, and the price adjusts very dramatically. Now, the question is, so the risk, okay, the risk part of it, okay, and how do you address it? Let's see how it would have gone. Let's take both the approaches. First, let's look at a momentum trader based on the system we have defined, 1 year and 3 months. Okay, so the 1 year time frame is this. Now, before this happens, okay, what could have happened before this happens? Now, the momentum trader sees that the long-term trend is up. Actually, you always start with the short-term trend because that's how you define your trading bias, and then you come to the long term to check whether you are not check to make sure that you're not violating any of the rules. Okay, now let's see what could have happened here as a momentum trader. Trying to, because this big jump has actually made it very difficult to see. But 1 minute, let me go back to 3 months. Okay, now in 3 months the trend was up. Okay, so as a momentum trader, the trend was up, and there was a neutralization, you could say here. It's very difficult to figure out this pattern here. Let me try and change the scale where the scale is, but you can see what was going on. Okay, there was an uptrend. This is before the jump happened. There was an uptrend, and this was the highest part, okay, of the uptrend, and this was the highest low from which a new high was made. So there was a little bit of a neutralization of the uptrend. If we focus in on this part here, okay, which is, if we go, I don't think it's able to be able to see this. Okay, it doesn't really help us much, but if we go back to 3 months, we can figure it out even without the ability to zoom, because it's not really helping with the display. Okay, so there was an uptrend, and there was a slight neutralization of the uptrend because this low from which the new high was made had been broken. Now, could you have been, so the real concern is what Siddharth is getting at is, or the important issue raised by his question is, how do I prevent, because obviously here the problem is for the guy who is short. When you have a jump like this, the real problem is for the guy who is short at this point. The guy who is long at this point has no problem. He is happy. Okay. So the problem is now, could we, using a TA approach, what Siddharth is saying, how could we have protected ourselves against using a pure TA approach? And remember, even if you use FA, unless you have insider information, you don't really have time to react to the news of the merger. Because once the news comes in, the market price adjusts almost immediately on the next open. So you can't react, okay? You don't have time to react. You have to react on this day, at this point. You can't really react. So even doing FA, unless you're tracking the market and trying to monitor things and trying to understand the trend or understand, so you still have to take a chance and bet on the merger. So even in FA, you can't really profit much, because unless you have inside information, you will be caught by surprise when the merger M&A news comes out. But let's look at a pure TA approach. How could it have protected you? So what you would have had is a uptrend and a slight neutralization of the uptrend. Okay. Now let's start with momentum. Now the momentum trader would not have been short. I'm not discussing the long side, okay, because the long side person has no problem with this in this situation. He's making money. The real risk is for the guy who was short and loses a huge amount of money because the market jumps. So would you have been short using a P or TA approach? Let's talk about momentum first. The momentum guy would not have been short because the trend was up, okay, and there was a slight neutralization of the uptrend, but he would not have been, there was a neutralization of the uptrend, but he would not have been short because when he looked at the long-term trend, it was also up. So remember, you have to be on the same side, both the trends, big picture, small picture. So the momentum trader would not have been short. Okay, is this clear to everybody? Yeah, Siddharth, you're clear about this part at this point? The momentum trader, pure TA momentum trader would not have been short going into this big price jump. Okay, that is clear. Now, let's talk about the mean reversion trader. What the mean reversion trader would have done? Again, you start with the small picture. He looks at an uptrend. He doesn't like the uptrend. He wants to go short. He looks at an uptrend. He wants to go short. If he saw a downtrend, he would want to go long. The mean reversion trader, he's following the uptrend, but he's not getting a sell signal because the lows are continuously higher and the uptrend is intact. Okay, high is higher, higher high, high, higher high, higher high, higher high, higher. Okay, maybe there was a slight neutralization here. Okay, we'll just ignore this to make the point, but we'll see. Now, what is the problem? But here there is a clear neutralization. So the momentum trader is very excited at this point, and he wants to go short because he sees this uptrend he sees that the uptrend has been neutralized in the small picture. It's been neutralized, so he gets a sell signal, initial sell signal. Okay, at this point he would like to go short, but remember, and in mean reversion also, you have to check for the second. Give on mute. Somewhere left is on.
Yes, sir. Yes, sir. I am telling him. Just a minute.
Contact Ketan and tell him to put it on mute. Okay. All right.
Yes, sir.
Yeah. Okay. Now we were checking as to whether the mean reversion trader using a pure TA approach would have been short. Well, there is a sell signal because this uptrend has been neutralized at this point when this low is lower than this low. Okay, which is the highest low. Until then, it was the highest low from which which was the highest low from which a new high was made. So the short-term uptrend has been neutralized at this point. So it appears to be a sell signal on the mean using a pure mean reversion approach. However, if you go and check the rule, it can't trade against the long-term pattern or trend. So ideally, the mean reversion trader would want to go short based on the short-term small picture signal. But when he looks at the long-term pattern, he sees that the long-term trend is up. So he can't go against the signal. So even the mean reversion trader would not have been short in this situation. Okay. So we saw both the situations. you can either do momentum or mean reversion, and that's it. All approaches are covered in those two approaches. All TA styles are covered within these two classifications. So therefore you see that even using a pure TA approach, which is quite a precise kind of approach, as you can see the method I'm teaching you, which is a very simple method, but actually it's a pretty good method. It's a pretty powerful method. You can just, if you want, you can change the time frames, but it's a pretty powerful method, and it's a pretty objective method as well. Although it seems very simple, it's pretty powerful. So you can see that even using a pure TA approach, okay, the issue that starts is rate, that you will never know whether you use FA or TA. You cannot predict the news that is going to come in the future, okay? So you can get all kinds of shock news and shock market price movements. But as you can see here, whether you are using momentum or mean reversion, the rules of pure TA, the rules of a simple trading system would have protected you, and you would not have had a short position. Mainly our concern is with the short position. You would not have had a short position going into this price jump. Okay, this is clear, Siddharth?
Yes, sir.
Okay, so everybody else is also clear. It's a good question. It's an important question because it leads to the discussion of risk. And as you can see, and this is where you see the value of the filter. The filter that I have put in, trend on both has to be the same. Can't trade against a long-term pattern. This is where you see the value of the filter. That's why we said, if you go back to Ford Motor, we don't want you to get excited here. Wow, great, we have a fantastic uptrend going on. Let's buy Ford Motor. When you go and look at the long-term trend, you see that the long-term trend is not at all impressive, and it's on the other side. So therefore, the two trends are not matching, and therefore you don't go wrong. So this is the beauty of using the long-term filter, that in many, many situations, it will protect you, and it will prevent you from entering positions against the long-term trend. And you'll find something very interesting, that a lot of the shock news, you will find that sometimes when there's a earnings news or some other kind of news, for new products coming out, vaccine trials, okay, new vaccine trials which are looking promising, some study comes out, etc. All these things, somehow you will find that the market tends to react, very often it reacts in the direction of the already existing long-term trend. So that's another reason why this using the long-term trend as a filter rule. Okay, these kind of rules. This is how you get how you protect yourself. Okay, all right. So far, any other questions? Now we have given you one clear way of deciding the solving this problem.
I have two questions.
Yes.
Sir, while like looking for immunonomatics, like if we have had gone short, for example, if the conditions for mean reversion applied, so sir, then we couldn't have hedged the risk, because even if we put a stop to, let's say, around 45, but the price will be but our order will be executed on about 80 or 85. So
Correct.
sir, there is no way to hedge the risk, to reduce the risk, right?
Yeah, that is the problem, and that actually what you're highlighting is. But first, let's be clear that if you had used a proper TA system, you would not have been. If you had followed the rules of a very simple TA system using a long-term filter, you would not have had a short position going into this. Okay, let's be clear about that. But coming to your theoretical question, it's an important question again. Yes. Now highlighting the risk. Okay, gap risk. Okay. So stop order may be executed with, this is called slippage. Okay, we are learning a new term. This is already defined in your, I think, in your DP5. If we come to DP5, I may have already defined it. I was going to define, we were going to DP5, the discussion. So DP4 discussion is now over for the moment. We are going to move to the other thing. I'll just see if I have slippage defined here in this note. So this thing is called slippage. Okay, we'll explain what slippage is, but for the writing part, okay, maybe it's not written here, but we'll write it here. The stop order may be executed with high slippage. This is what we say. This is the term that we use. Slippage. Okay, what is slippage? Slippage, you can see already visually what it means. That means it's slipping basically. Slippage means when you put your foot somewhere, there's water and your foot slips and moves away. So you intended place and actual place, there's a big slip, okay, movement. So obviously, if for some reason you had gone short here, then your stop would have been over here. So actually this requires a discussion of the 6.2 also that I was going to go into that straight. But clearly you can see, let's understand this first initially. I'll use this as an opportunity to segue into the 6.2 discussion, which is how to set the spots, the stop. So what Siddharth is saying is that, I don't know if we get a better picture here. It doesn't really help us much. Okay, so maybe we can use even that it doesn't help. Okay, let's go back to 3 minutes. We can see, everybody can see this actually. That essentially what was happening is, if you had gone short here, okay, what is the, if you had gone short here, okay, if we had gone short here, then if we had gone short over here, what is our view? If I go short, what does that mean? That means I expect a downtrend. I expect prices to fall. I expect a downtrend. And obviously, if there is any, and what proves my view to be wrong? If the uptrend makes a new high, then obviously my view is incorrect because I said there would be a downtrend. Okay, I may not have said it, but the fact that I'm going short means that I'm expecting a downtrend. So as soon as the market makes a new high, okay, and the uptrend, which was already in place, if that makes a new high, then you have a new high in the uptrend, that proves that my theory of a downtrend is wrong. Because in a downtrend, I should get lower highs. This is the highest point so far when I enter my short position. And short position means I expect a downtrend. So therefore, I should have lower highs and lower lows. So what I should have, ideally, when I go short, in order to prove that my view is correct, I should have lower highs, which means any high that is made should be lower than the previous highest high. And then I should continue to get lower lows. So ideally, it should stay below this high, and it should then eventually break below this low, which is similar to the idea that Vipul was talking about in the previous class towards the end, okay, that you wait for a new downtrend to develop. And so if this happens, the price remains below this previous high, so the next high is a lower high, and then it falls below this low, which is then it makes a lower low. And then it keeps having a pattern like that, lower lows and lower highs, and keeps going down. That would be the ideal pattern movement, I mean price movement, price pattern that would confirm the implied view of my short position. And therefore, what I have to do is, we are getting into the stop logic now. We are now moving into the stop logic. Okay, while we understand, we are looking at this exit point 6.2. We're going to discuss this. So therefore, remember, what is the logic for this position? We will discuss slippage, but before that, we will also essentially discuss the logic of this. Now we are going into the 6.2 discussion. How do you decide this? And we have already discussed the logic once before. Okay. What is the other logic that we have discussed? The logic is that essentially, if you have gone short, that means you're assuming that a downtrend is going to develop. Okay. So therefore, as a general principle, when you do anything, you do it on the basis of certain assumptions, especially in the markets where there's high uncertainty. You don't really know what's going to happen. You assume that certain things will happen, and based on that, those assumptions, you take your decision, or you act in a certain way. So here you assume that a downtrend will develop, and therefore you assume that, and based on the assumption, you go short. So now we have to ask ourselves, like, if we are asking this question, exit price with loss, okay, exit price with loss, when that means at what point do I exit if I start showing losses, if my position starts showing losses. We have to take a view on this and come up with a decision solution to this DP. And so what we say is, look at this. So we are going short here. Now for that, to answer that question, we use the general principle that if I have taken a decision based on certain assumptions, and if I can see that those assumptions are no longer correct, then I should ideally reverse that decision if it is possible. And in the markets, it is possible. Okay. So therefore, now what was my assumption? The assumption was that a downtrend would develop. So what is the clearest indicator that my assumption is definitely wrong? The development of an uptrend is or the continuation of the uptrend is a clear sort of a refutation of my assumption. It clearly destroys my assumption. So the price point at which my assumption is clearly destroyed, my assumption of a downtrend, is where instead of getting lower highs from here, lower highs, I actually get a higher high. So this is the point where my stop needs to be. Okay, whatever this point is. Okay, you can read out off the cursor. It looks to be something like 45.65. Okay, if you see the stuff over here, I think it's around 45.65. Okay, so this is where. So what I do is I look at the chart. I know that if I get a higher high, then my assumption about the downtrend is about the future downtrend to develop. That assumption has been destroyed completely, clearly destroyed. So I have to now get out of my position. So that's why the stop needs to be here, 45.65. Okay. Is everybody clear about the logic here? Why my stop needs to be here? How we came up with the logic? I will answer Siddharth's question and we'll get to the question of slippage. But first we need to understand the logic. Remember, always go with the basic principles and the logic. And don't try to memorize things. Then you'll understand. Very simple, common sense principle. You do something based on certain assumptions. Okay. Understand the implied assumptions of your decision. If your decision is to go short, then obviously you're not a fool. You don't want to lose money. You are trying to make money. If you're going short and we know you're trying to make money, and you're going short, that means clearly that you think the market will keep declining. That means you think that a downtrend will develop. A downtrend is lower highs, lower lows. So this, whatever high is formed here should be lower than this high, and this low should break to the downside and should keep getting lower highs, lower lows. That's your assumption. Okay? And so if you actually instead you get a higher high, that's the point where your assumptions are completely destroyed. And so that's where you must keep your position. That's the level for your stop, 6.2. At what price do I exit the market with a loss? And the answer is this high. It's here, it is 45.65. Okay. I hope everybody's clear about this logic.
Sir, can you repeat the part that how a certain higher high and a higher low is reached, but how does it destroy the assumption? Can you repeat it again, sir?
Okay, so let's look at a bit, because here the picture is not very clear. So let's take another example, which is, let's take GE. We'll come back. Okay. Now here, if you see GE, now if you move, we can even move this out, so you don't have to stick. Since I'm just explaining this, okay. So I want to explain this point. Okay. Now you see what happens is, like, if you have a momentum trader, Okay. If we are ignoring these, the highs that I'm considering a high, maybe this high, okay, this high, and, or we can even take the simple, keep it simple. This high, I'm not considering the small pattern. This high, and this high. The three highs I'm considering. That is the level of zoom I'm looking at. 1, 2, 3, 4, 5. Okay. So high, high, and high. I just want you to focus at this level of zoom. High, high, and high. Low, low, and low. All the lows so far at this point, when I'm standing here, but this has not happened. I'm standing here. Okay. Or let's say, make it clear, I'm standing here at this point. Okay. Here. All the lows are lower, all the highs are higher. All the highs are
Yes, sir.
all the highs are also lower. Okay. So now,
Okay.
at this point, if I go short, the assumption is basically that obviously, if I'm going short, means I expect a continuing downtrend because I want to make money like everybody else. And if
Yes, sir.
I go short, in order to make money, the price has to keep falling further, right? So therefore, by looking at my
In order to make money, or should I say like in order to like curb losses, like so that I don't face further loss.
no, I'm coming to the loss, but I'm making the statement I'm making now is I'm talking about how you can infer your assumptions by looking at what you're doing in the market. I can make an inference about what your market view is. If I see
Okay.
short, that's what I'm talking about right now. Okay, we are coming to your larger question,
Okay.
but I'm setting it up by setting up the basic assumptions. Okay, I look at your actions. I see you going short. That means I no longer have to ask you what is your view, because I know what your view is. Your view is bearish. You expect the market to decline. That's why you're going short. Okay. So there's an implied assumption here that I assume obviously like everybody wants to make money. How do I come to that conclusion? Because I know everyone wants to make money. So if you're going short and I know you want to make money, and how are you going to make money if you're going short? You can only do that if the market keeps on declining. So therefore, I assume that, therefore, I can infer from your action of going short that your view is actually bearish, that the market will keep on declining. Is this clear so far?
Yes, sir.
We want to go everything, we want everything. This is very simple actually, but I want to go by stepwise logic so that nobody is confused, everybody understands the logical foundation.
Okay, sir.
To remember, memorize things, we want to understand it conceptually. Now, I look at your actions, I figure out your implied assumption about the expected future trend of the market. In this case, if you're going short, the expected future trend is further losses, further downtrend, a continuing downtrend. Okay. Now, what is the definition of a downtrend? Remember, lower highs,
Lower highs and lower lows.
lower highs, lower lows. So now, therefore, and what is the condition for maintaining a downtrend? Lower highs. Remember that?
Yes, sir.
Condition for maintaining is lower highs. So therefore, if the downtrend is no longer maintained, then your assumption is destroyed.
Yes, sir.
You assume that the downtrend would continue, and if we can show that the downtrend is no longer maintained, then your assumption is destroyed, right?
Now higher highs are occurring, hence
So
the assumption destroyed.
yeah, if the pattern of lower highs is destroyed, then your assumption is destroyed. Okay, pattern of lower highs is destroyed means the downtrend is no longer being maintained. It is no longer intact. It is now neutralized. Okay, so the downtrend is neutralized. So your assumption about continuing downtrend, which we can see that you expect because you're going short, that assumption is destroyed. Is this clear now?
Yes, sir.
Okay, so that's why we put this. Remember, the decision problem we are trying to solve is this one. At what price? Because we want you to plan everything ahead of time. You plan for everything. Okay, you don't first take a position, which is what most people do actually in the markets. Most people, they buy some stuff, they buy lots of a big position, and then it drops, then they buy some more, and then eventually the losses are getting really big, and then they start asking, my God, now what should we do now? They don't really have a plan. So you have to plan everything ahead of time. So what you do is, as you are going short, you should also have a plan for this decision problem. If I start showing losses, at what point should I exit the market, exit my position, close my position, because I'm showing losses and I don't want my losses to increase? So the answer to that question is, the general principle is, very general principle. You do something based on certain assumptions. When those assumptions are destroyed, then you try to unwind your action if possible. Okay, here you can do it because you can just buy back your short position, all right? And the point that you do it is basically the point where your assumption is destroyed, which is this point in this case. Is this clear? Yes, Shaurya, is clear now?
Yes, sir.
Now let's go back.
Yes, sir.
Yeah. So let's go to EMU. Yeah. Right. So using that same logic, hypothetically, as I said, once again, we remember that even if you are using pure TA, the beauty of the long-term filter is that it keeps you out of positions against the big picture trend, and in many situations, it protects you. Okay, so you can see here, using pure TA, you would not have had a short position going into this. But if you did, for some reason, if you had just gone short, where would your stop have been? If you had gone short at this point, it means you are expecting a downtrend. A downtrend has to be lower highs, lower lows. Okay, so the condition for maintaining the downtrend will be destroyed if you have a higher high. So the moment this high is broken to the upside, new high is made. Okay, then that's the point where your assumption is destroyed, and so that's where you would have had your stop. Okay, everyone is clear about this so far?
Sir, one more question, sir.
Yeah.
Sir, if in the long trend, long time frame, it shows that it has a general downtrend, that is lower lows and lower highs, right?
Okay.
And but in the short term, there are like higher highs for some time and lower highs as well. So we should generally avoid that kind of stock, generally speaking.
No. Why are you talking in generalities? Now, as far as the technical trading system is concerned, okay, I have already given you a framework. Okay, I've already given you this framework for trading. You seem to be showing a tendency, Shaurya, you're showing a tendency to continue to talk in general terms and layman's terms when even after I have already given you very precise rules. Okay, so there are only two ways to approach technical trading. Either you're a momentum trader or you're a mean reversion trader. In both cases, we have given you very simple and precise rules. Okay. So if you, as I gave you the example of, let's say, Ford Motor, when you look at your short-term small picture is 3 months, the example I gave you. Okay. When you look at Ford Motor 3 months, you see an uptrend, you see low, higher low, higher low, high, maybe this is the high, high, higher high, okay, and not yet high, a new high, but this one. You already have two highs, okay, here and here. You have two lows. So already at this point, you had a new uptrend, okay, and there is no destruction of the uptrend, okay. So ordinarily, you want to be going long as a momentum trader, but when you check your rules, trend on both time frames has to be same, okay,
Yes, sir.
have to be intact. So in terms of short term, it is an intact uptrend, but when you go to your long term, 1 year, you see that there is a downtrend. So therefore,
Yes, sir.
the first rule is not satisfying. So therefore, you can't do anything. You have to move on to the next ticker. Okay. So there is no decision to be taken here. At this point, we do not have a clear buy-sell solution to the fourth DP. There is no clear, because the two are conflicting with each other, the two time frames. So this is a clear rule that you should just apply this rule. Don't, basically, I think what is happening with you, Shaurya, is you're not spending enough time and understanding the rules. Try to lock the very precise rules I'm giving you, and that will help you that will also prevent you from getting confused with all these general terms and general thinking. Okay, every situation that you can encounter, we have already covered. Okay, you will see a downtrend or an uptrend. You may see sometimes, for instance, in the case of PG, which we have shown you, is, let's say if you look at 3 months, we have shown you, okay, there is an uptrend because we have defined uptrend as minimum point, maximum point. If maximum point is made later than minimum point, then it is an uptrend. Okay,
Yes, sir.
we have defined characteristics of uptrends, higher highs, higher lows. And now we have defined one more property of a trend, which is whether the trend is intact or neutralized. In this case, you see at this point, September,
Neutralized.
yeah, the uptrend is, so here what you will say about PG is that it's an uptrend, but it has been neutralized.
Yes,
Okay.
sir.
Very, very precise. So these rules are very simple, but they give you some very precise assessments of what is happening on a price chart. Okay. So try to practice applying the precise rules I've given you, then you will not get confused. Okay.
Yes, sir. Actually, the combination of it is like weighing hard on me right now. I
No,
think I should.
you have to practice, no, because these
Yes,
are,
sir.
everything comes with practice.
Yes, sir.
So that, don't worry about that. But the main thing is you have to practice, and then eventually it will become easier. That is how everything works. Because it's the reason it's a little confusing, not because you're stupid, but because these are new ideas. So if you're getting
Yes,
highly
sir.
new ideas thrown at you, unless you practice, it will not become easy to repeat it. So everything is practice. So when you don't understand something, just try, keep practicing, then eventually it will become clear.
Okay, sir.
Okay, let's go back to the point that Siddharth raised about the risk. Now that everybody, we go back to immunomedics. Okay, are we over the time? This class is ending at 11, right? We are over the time. Okay, so I'll let you, because today I forgot to set the alarm. So what I'm going to do is, I'm going to just very briefly, it's about 4 minutes over the time, I don't want to delay you too much. But here you see a problem. We'll discuss this problem in the next class. Okay, so I don't want to, because you have another class at 11:15. So, okay guys, so class is dismissed, you can go. Anybody has a question can stay. So that's question we will deal with. I want everybody to listen to this, so we will deal with this question later in the next class. Okay, we'll open up with the next question with this class. What is slippage? I'll explain it in the next class. We will also go into, we'll first go into 6.2, and then I want to first deal with these three, complete our simplistic system, and then we will go into the discussion of the other two also. Okay. Yeah, you can go. Mitali, I looked at your question. Okay. You may want to read this once again. I don't know. I got the impression that you are maybe.
Sir, yeah, sir, I had a conversation with Utsav, and Utsav explained me a bit of it, that why is it happening.
Yeah.
So I yesterday only, so I will try that today.
Okay, try it. Read the DP.
Yes, sir. Yes, sir.
Okay, read this.
So
note.
your voice is break.
My voice is breaking.
Yes, sir. Yes, sir.
Your voice is also breaking. Okay. All right, never mind. So you guys can go for your
Yes.
break, and then so we'll continue in the next class. Okay. Anybody
Thank
has?
you, sir.
Yes. Hello.
Okay. No, the class is dismissed, so you can leave. Okay. All right. I'll just.
Hello.
Then I'll stop recording.
Hello. Hello. Can you hear me, sir?
Yeah. What is the question?
Sir, I had another question, another hypothetical actually. Like in that case in immunomedics, we had an announcement about merger and acquisition.
Yeah.
But sir, had it been, if our position had been short, and if the position, if the announcement was of the earnings, like one point you mentioned about earnings. So sir, we know from research that the earnings, the prices likely to drift in the direction of the earnings. So if our position is short and we haven't triggered a stop price yet, so sir, we know that the prices, if there has been positive earnings, we know that the prices will drift to the towards on the higher side. So, sir, should we take that into a factor while doing TA?
No, the answer is no. If you're trading from a purely technical perspective, the answer is no. Because see that statement that you made, that statement is not a rule that we can apply like a rule of gravity, etc. in physics. Okay, in physics, in gravity, we can always tell you that I can guarantee you that if you go to the 70th floor and jump off without a parachute, you are definitely going to die, and that statement is always going to be true. Okay, but here that statement that you made is not necessarily always true. We see many times. I'll give you an example. Okay, I have personally lost a lot. Many occasions I've lost money in very big names like Procter and Gamble, Exxon Mobil, etc., where you had situations. These are all big name stocks. You had actually got positive earnings. You had positive earnings, but the price declined. Okay, so Facebook, if we look at 5 years, yeah. Now, if you look at this decline, this big decline in Facebook is actually on the basis of, is on the back of very good earnings actually. The earnings beat the estimates on all fronts, and still the price declined because the projections were, the statements that they made, the guidance was not so, the guidance was not bad either, but the guidance was not as good as the market expected. So the problem in markets, in financial markets, in every asset class is that you don't know how the market is going to react. So I would object to your statement that you made that the price is going to go in the direction of the earnings. Not necessarily, you can't rely on that statement, okay? In the sense that you can rely on the gravitational pull of the earth, that you can always rely on. That statement is not always true, okay? And you don't know when it's not going to be true. So that statement is not true. So generally and so that's the first warning, okay? Don't assume that that statement is true. This is a very good example in Facebook, and I've seen many other examples in my life where, in my own trading experience, where the news is of one type, but the reaction is different, okay? So that's one. Second is that as a technical trader, you should not, let's say if you have gone short, okay, and the earnings are very good and the market is rising, okay, and you think that based on your application of your rule, the market will make a new high and go over this, and that's your stop. Your stop is over here, and the market is rising. And you're trying to, essentially what you're saying is, should I preempt my stop? Okay, this is called preemption. Okay, so preemptive move, like somebody is trying to exit the room, and in a preemptive move, I'm shutting the door or blocking his access to the exit so that he can't exit the room. So I preempt my stop. My stop is actually here. I have placed it in the market, but before it triggers, I'm trying to preempt my stop and exit over here itself because I can see that the earnings are very good. This is what you're asking, right, Siddharth?
Yes, sir.
Yeah. So in this case, I would say as a pure technical trader, you should not do that. You stick to the objective system. Okay, because there is no guarantee that it will go up and break. Because that first statement that you made, that statement is not always true. It's not reliable. So you must not do that. You should actually let the market do it, because the market need not always do it. Okay, you are, remember, as a technical trader, you are concerned with price. You're not concerned with the news, because the market doesn't react to the same news all the time in the same way. Is this clear?
Yes, sir.
Okay. All right. So we have you have 4 minutes left for your next class. Okay. So should we end it here now?
Yes, sir. Just one last thing, sir. Where should I learn more about indicators and patterns? Like I'm very interested in this, and I want to learn more about it.
Yeah. For that, I have given you a link right on top. Chart School. Okay, and you can read the the book that I've given you from Perry Kaufman. It's in your finance reference.
Okay.
Remember, so you can read Perry Kaufman.
Yes, sir. Trading systems.
Don't read John Murphy, and then you can read the Chart School link I've given you here, session notes. It's there in this one also, I think. I think I put it here also. Yeah, chart school link. So any important links putting here as well. Okay. So use this to read about indicators and read the Kaufman book. Okay. Anything by Perry Kaufman you can read. Very high quality stuff. Okay. Okay, so we'll finish it off now.
Thank you, sir.